Hello, hello. Welcome back to Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. Happy Sunday, everybody. After a few days of consolidating price action, it's a good idea to check in with the on-chain and derivatives landscape to make sure we're not seeing any surprises brewing under the surface. We'll also take a few moments to squash a bit of the Twitter FUD I've seen in the last couple days, suggesting that we have a bunch of whales preparing to exit the market. I'm not seeing data to support that, and we'll go through that in this video. If you enjoy this content, please give this video a thumbs up and be sure to subscribe to my channel. It means a lot for the growth of this community that you subscribe. If you hit the bell icon next to the subscribe button, you'll be told about all of my videos the moment they come out. Please excuse my voice today. It feels a bit scratchy and I might sound under the weather, but regardless, there's work to be done and there's Bitcoin to talk about, so let's get right into it. Let's start our day with the price chart. So we've been continuing to hang out above 54,000. It's very encouraging. When we last spoke on October 7th, we were right here. We had just broken over 54K and we were looking for support, and we have held support. Not only held it, it looks like we're making higher lows. This is on a very small time frame, so I wouldn't get carried away here, but this is great. Just hanging around up here. We zoom out and we look at this level. This spot from 52 to 54,000 has been significant this year. You can see that this level was tested numerous times in the spring before price finally broke below it, and when it couldn't get back above, it sent us into the bear summer. We spent a few months down here consolidating and building strength, and when we got back up here, this was September 7th. This was the day that El Salvador made Bitcoin legal tender and the laws went into practice. This day, we rejected this support level. Spent a few weeks in consolidation, building strength. We've now broken above this level and are finding support atop it. This is great. We'd love to see this continue. This shows strength in the market, and it shows that a lot of the people who were doubting these price levels have been shaken out. You know, the longer Bitcoin rubs up against 52 and 54,000, the less scary those prices become. They become more normalized, and we're seeing that in action here, I believe. Another thing about this formation here, this is a cup and handle. So you get the pullback, it comes back up to the same area, fails it, builds strength, breaks above it, you get the bounce. Here's the handle of the cup, and this is the setup. This is the entry point for the move up, and the target would be the highs. This formation is setting up here. We talk about trading setups on here occasionally as other traders are looking at them. So those setups are valuable to some percentage of the market. And lastly, we'll throw on our Fibonacci retracement here, and we can see that we're just hanging out right here above the key 702 level where crypto rallies are made or broken. The next significant spot here is the 786 at 57,000. Once we get above this, I'll feel very good about this rally. I still feel good about it now, but this is really the last red flag from my technical analysis perspective. All this looks very good, but we know that our focus is with on-chain and with the derivatives market, so let's hop on over there. In my last video, and in a tweet I sent on Friday, I said that I was a bit concerned about the derivatives market because it showed a profile similar to September when we got a flush on El Salvador's Bitcoin Day. If you recall, futures open interest is the total USD dollar amount of all open contracts in the futures market, which rides alongside the spot market. The spot market is where people buy and sell the actual Bitcoin that they want to own and trade, where the derivatives market is more speculation on price. You don't actually own the Bitcoin in the trade, but you do collateralize your position with either Bitcoin or a stable coin or cash equivalent. So this chart here is showing you the total volume, the total value of all the open contracts, and it gives you a sense of the speculative interest in the market on a given day. What we've seen in the last few days is that the amount of open interest, the volume of open contracts, has remained flat. It hasn't continued spiking. It hasn't fallen off. It's just kind of stayed flat here these last few days of October as we've been hanging out up here near the new local highs. It's hard to get a read on this in terms of what I think it's going to do. The amount of open interest is still on the higher side compared to most of this year. Here, let me zoom out to January. Compared to most of this year, it's on the higher side, but it remains kind of steady. And a derivatives market is here to stay. This isn't something that's just going to dwindle away and that we won't have to worry about. So this will continue to be a factor, and the nuance of how it affects price is part of the learning process of this analysis. Right now, it's hard to get a new feel for what I think it will do. I'm still feeling a bit cautious because the volume is higher, but there's no new observations here other than the fact that it's remained steady. If we hop over here to the funding rate, if you'll recall, this is a barometer for the amount of bias and leverage that's in the futures market, that's in those open interest contracts that we were just looking at. When this gets stretched for a period of time in one direction, it's showing you a building bias amongst all the traders that have open positions. And if it gets stretched too far in the wrong direction and price momentarily goes against it, we can see a quick reversal and some liquidations. That's what happened in September. Let's zoom in more so we get a better look at this. Here's early September. Here was El Salvador's Bitcoin day. You can see funding had spiked quite a bit in the days leading up, and then we got a bit of a drop in the early morning, and it caused a massive liquidation. When that happened, futures open interest contracts, here it is, wiped out. A bunch of them got cleared. Many billions of dollars got cleared, and the funding rate reset back to zero. All these leveraged longs got squeezed out, and the system found its equilibrium. We can see here it has been building, and this spike here on October 7th, this was what caused me to be concerned. This was why I sent out a tweet about being on your toes, and this was why I mentioned it in the previous video. Over the last couple of days, the funding has cooled off a bit, back down to this 0.01% kind of positive baseline. It's not even, it's not at a complete equilibrium, it is still a little biased to the long side, but it seems to have found a steady point right now. There doesn't seem to be a lot of volatility. This isn't quickly growing in one direction or the other, but we need to watch it, because if you look over here, you can see it can spend one day down in a lower value and then just hop right back up. So we might see on Monday this spike back up as the weekend ends. We'll have to observe. So at the moment, I am cautious, but mildly less concerned than I was on Friday. Now let's hop into some of the on-chain stuff. Here is the hash rate. This is the total computing power of all miners on the network globally. It's been mostly in an uptrend throughout Bitcoin's life as there's a perpetual arms race to produce more and more mining power for the network. That is great. That helps to strengthen network security and make it more resilient to attack. So we like this. We like increased hash rate. What you can see here in the spring, this is when China banned industrial mining, and we fell about 50%. About half of the hash rate on the network was taken out over a period of weeks. It first started with the sell-off. Some miners went offline as their profitability on the margins was tested. So a few miners turned off some machines, and you see hash rate coming down. And then around here, China bans industrial mining, and you just see this precipitous fall as a lot of companies over in the East start taking their machines offline and preparing to migrate. In the Bitcoin world, we call this the Great Migration. It occurred over a series of months, and you can see now that since the bottom here in early July, you can see the bottom here was about 88. Let me zoom in. You can see here the bottom in July was 88 exahash, which is 88 with 18 zeros after it. And since then, miners have been coming back online, and we've now recovered about 60% of the lost hash rate from the high earlier this year. Incredible. Bitcoin loses half of its hash power, and the network doesn't skip a beat. Did you notice? No. No one who uses Bitcoin was even aware that this happened unless you're plugged into the news cycle. It shows you how resilient this network is to adversity, and it's just another battle that it has come out of the other side victorious from. Every time this protocol is tested, it finds a way to win, and it just continues to galvanize my confidence in Bitcoin over the long term, over the decades long term. I do want to touch on some of the supply metrics. So there's been some rumors around Twitter this weekend that whales were dumping and that coins were flooding to exchanges and that this was the great sell-off moment that everyone has been afraid of. A lot of FUD going around on Twitter over the last couple of days, and we're going to set it straight now. This is the distribution of supply broken up by entity sizes. Okay, so the amount of Bitcoin that individuals own on chain, we group them together here in these different lines, and we'll walk through these. First, I'll throw on the price. This black line here so you can get an idea of where we are. Here's the spring rally, bounce around. Here's the all-time high in April. Here is May, the sell-off. Here's our accumulation over the summer. Here's the B-word conference. Here's September, and here we are in October. Okay, you follow that? Turn this off so we have less lines. This red line here, these are all entities that have less than 1 Bitcoin. We've shown this one before. No change here. This line just goes continually up. These are folks with 1 to 10 Bitcoin, also in heavy accumulation, and they have been, if I turn the price on, since the summer. Look at this. Basically, since the sell-off ended, this group has been buying. This green line, these are folks that have 10 to 100 Bitcoin. They have been growing their stack slowly. This is only about 20,000 Bitcoin that has entered this group. That's okay. They only have 10 to 100. So that's a lot. You add a few thousands of Bitcoin here to a group that only has 10 to 100. That's a lot of accumulation for them. All right, this one here, these are folks that have 100 to 1,000 Bitcoin. You can see it's mostly flat, and actually in the last few weeks since mid-September, this group has been growing a bit. It's possible some of these are people graduating from the 10 to 100 group, from this group. You know, when they pass 100 Bitcoin in their possession, they just suddenly appear in this group up here. So some of that is maturation. Okay, this is the line I really want to focus on. This one here. This is the supply held by entities with a balance more than 1,000 Bitcoin. Let me zoom in on this group so we see their entire history here this year. All right, this is their history from March. And I want you to notice this axis over here. Each one of these values is 100,000 Bitcoin. Each one of these numbers here is another 100,000 Bitcoin. And everyone in this group owns at least 1,000, right? We've taken out exchanges. We've taken out Grayscale. We've taken out all of the known entities, ETFs, companies, whatever that we do have. Heuristically, we've removed them. So there's no exchanges in here. This should just be individuals and smaller companies and private firms for the most part. This group, flat during the summer. Some selling, some buying. It results in a net flat supply for this group. There was some acquisition here in late July. It looks like maybe a new buyer entered the market, or an existing whale decided to buy a chunk of change. One of those two things happened. This group remained flat. They grew again in late August, entering into September. There was a growth here. Let's see, where do we go? From about 6.03 million coins up to 6.15 million coins. So 120,000 coins got added here. And since then, since they were at 6.15 million, they've now distributed a few more, and they're down to 6.07 million. So 0.08 million coins. So about 80,000 coins have been sold since September to now in this entire group of investors. This is hardly whales dumping. This is distribution, and it's happening over a period of weeks. And frankly, as they've continued to distribute, price has held steady or risen. So it's not just a matter of, oh my gosh, the whales have decided to start selling, panic. Well, let's look at it in context. How is price being affected by these decisions these large holders are making? If they see an opportunity to let go of some coins, that's totally fine. What's more important is whether or not the market can absorb it, and they clearly have. So I'm not concerned about this. And if you hear FUD about whales dumping, let's step back and look at it contextually, because you get a different idea when you see it in relation to their behavior over the last few months. Not concerned here. If we see this value going down heavily and price can't support it, price starts losing ground as a result, then maybe we should be more concerned. Maybe we start waving a yellow flag, but we're not there yet. One of the other things mentioned with some of the FUD I saw was that exchange balances are going up, that coins are being flooded onto exchanges in preparation for sell. This is the total balance of all exchanges over the last 3 years. What do you see here? You see a downtrend. Look at this. There was a spike here in the spring when we sold off. You can see it's almost inverse to price here. But since September started, this has been in down to flat territory. Nothing really to write home about here. Nothing interesting. Certainly not coins flooding exchanges. Don't believe everything you hear on Twitter, folks. Right now, there's nothing to say about exchange balances because they aren't changing in either direction. But it's a feather in the cap of continued restricted supply, because as prices are going up, folks are not seeing this as an opportunity to put their coins on the exchange and prepare to exit. We're just not there yet. I suspect we'll start to see this value increase as we get closer to 60,000, which we're not far away from now. We're at 55. This could start to change quickly. But again, what will truly matter is whether or not the amount of coins that get pushed onto exchanges and put up for sale, if that amount overpowers whatever demand volume exists at the time. All of this comes back to supply and demand. Coins going on the exchange can be interpreted slightly bearishly, but it's not a direct correlation to negative price. We need to look at things in context. Here are our spent volume age bands. This is a veteran chart of this channel. These are the spent coins every day that are 6 months or older. So these are older hands. This group is not spending. You can see here back last winter, this is an elevated, continued burst of activity from older hands selling, and it kind of went until, the sell-off here, really. This was a sustained period of older coins moving. It began to reduce in this area here, but this was several months of this happening. Over here, look, it still remains quiet, and even if we turn on 3-month coins and just get a little closer, you can still see the volume is relatively low compared to where it has been most of the year. I mean, we're still talking 1% or so of daily volume if you look at this axis over here. No concerns yet. There was a slight increase in 3-month coins recently. These are people who bought between July and now. I'm not super concerned. We continue to watch this chart because if we start seeing big spikes like we did back here, I went back too far, but this is the winter here. If we start seeing big volume prints here, then maybe we start getting a little more cautious. This was something I was tinkering around with over the weekend, and I thought it was pretty interesting, so I saved it for this video. What we're looking at here is the growth of illiquid supply versus the growth of the coin supply. Illiquid supply is a metric we've followed closely on this channel. Liquidity, the determination of whether an entity on chain is liquid or illiquid, not liquid, is based on their historical spending behavior. So a liquid entity, a more fluid entity, is more favorable to selling. They have a higher percentage of outflows compared to the hodler types. They may sell 50% or 75% of the Bitcoin that they buy historically. There's constantly coins coming in and out of more liquid entities. Illiquid entities, not liquid entities, tend to sell less than 25% of their Bitcoin. Tend to sell less than 25% of their Bitcoin lifetime, all the way down to none, to people who never sell. Those are the illiquid types. And when their supply is growing, we can make the assumption that hodlers are dominating and that the confidence in them remains high because they are continuing to take supply offline to put them into cold storage and to make them less available for new buyers. This is a dynamic that we follow closely on this channel as we're highly interested in the underlying supply profile for Bitcoin. Here, we're looking at the growth of that illiquid supply, the growth of that supply held by hodlers and strong hands, compared to the amount of new Bitcoin being added to the network every day by miners discovering blocks. When this value is above the black horizontal line, it means that illiquid supply is outgrowing coin issuance. Means that every day illiquid supply is picking up more Bitcoin than are being given to miners in the block reward. You can see for the last 2 years, from late 2019 to now, coin issuance has been outpaced by illiquid supply almost non-stop, save for a brief period of time in early 2020 and for the first part of the summer as we tried to recover from our 50% correction. You can really see if you follow this is looking at the rate of change, right? This formula here is the 60-day rate of change of illiquid supply and the 60-day rate of change of circulating supply, which is coin issuance. If you follow the trend of illiquid supply, it really bottomed out here in June, and since then it has been rocket shipping up. It just shot up. Supply grew very quickly, has remained a bit steady, and continues to grow. This is a growth rate above zero. Not only is it a growth rate above zero, it is growing faster than coin issuance. This is bullish. There's no other way to put it, but this is bullish. You want supply held by hodlers. For Bitcoin to continue to see price appreciation and to turn new heads and to get more people interested in entering this market, we need the hodlers to continue doing hodler things. They need to continue to remain strong, to buy up Bitcoin at whatever price, and not to put it up for sale. These illiquid entities have a history of not selling. These are not just long-term holders who let their coins sit for 6 months and then sell into market strength. Many of these people in this illiquid supply group don't sell their coins under any circumstances, or they sell very few of them. And the fact that they continue to pick up Bitcoin at a faster pace than coin issuance is demonstrating a long-term, zoomed-out supply restriction. And if you've ever taken an Economics 101 course, basic supply and demand dictates that when supply is low and demand volume suddenly increases, prices increase with it. So this dynamic is great, and we'd like to see this trend remain above the positive here. If you'd like to see these formulas and play around with this, I'll leave a link to this Workbench chart in the description below. Here's the last chart I want to touch on today. So I sent a tweet out about this on the weekend, and I want to break it down for my audience in case anyone still had questions about my interpretation of this. This is showing you the on-chain transfer volume in dollar terms as a percentage of the realized cap. So there was a previous video called Back to the Beginning where I explained what the realized cap was. And I'll leave a link to that below if you want to deep dive how we break down the realized cap. In brief terms, it's the amount of dollars Bitcoin holders paid for their coins in the aggregate. It's not the sticker price. It's not the market cap, which is what the value of all coins are based on the current market price. The realized cap is the dollar amount that hodlers actually paid for all of the current coins in circulation. This orange line is transfer volume as a percentage of the value stored on the network. So it's the value of day-to-day network activity compared to the amount of value committed to the network by holders. This gray line down here represents 3% of realized cap. And what I've noticed in my observations is that when transfer volume gets above 3% of realized cap, it tends to signify the beginning of bullish periods. And likewise, when it breaks below 3%, it's usually an accumulation phase. You can see here when transfer volume gets over 3%, you zoom in. When transfer volume gets over 3% and finds a support here above my mouse cursor, it tends to send us into price appreciation. And when it breaks down below it, it's an accumulation phase. And then we tend to find support again above it. As activity rises, so does price. Here in 2011, activity stayed elevated, came back down, tested 3% of realized cap again, and then off it went. And this was really the entire 2011 bull run. Transfer volume declines precipitously, gets back down below 3% of realized cap, and it stays here for a while. There's an anomaly right here, but it happened so quickly that I don't even know, if I had been reporting on-chain back then. We didn't have this metric back then. But if we had been looking at this and this had happened this way, I don't even know if we would have been excited about this because it doesn't gain any support. It just shoots off out, goes straight to the moon. Price did go up after this, but this is more of an anomaly, I would say. There are better signals on this chart. Here you can see it building support in 2012, and this helped propel it into the 2013 and 2014 bull run. As transfer demand volume increased, price appreciated with it. Here we are zoomed in on the last two bull runs. If you look, transfer volume stayed below 3% of realized cap for quite a while here, consolidating during the depths of the 2014-2015 bear. And then as volume began to spike, it actually started finding support here on this 3% line that we drew. And once it really caught this, once volume decided it was here to stay, price started really taking off and the transfer volume went with it. And then on the back of the bull run, it just fell off. And once it got below 3%, look, it even tested it and found it as resistance. And this really sent us into a proper bear accumulation that lasted multiple years. Even look here. Let me zoom in on this. Look at how it finds trouble getting back over 3% of realized cap here. This level seems to be a significant relative amount of realized cap for transfer volume to be considered high or not. Here, I've zoomed us in on 2019 and 2020. This is the most recent market with transfer volume here as a percentage of realized cap. Note how in the bull run from 2020, we got over 3% of realized cap and we bounced around here, and every time it bounced off of it was another rally. Eventually, we broke down below, and this was just showing the volume falling off. Volume disappearing off chain, demand going away, and you can tell in the price that we had a lot of accumulation here. Well, we've now found our bounce off of 3% of realized cap here in late 2021. The observation of looking at transfer volume this way is that when we see it get above 3% of realized cap, that is typically an indication that demand is increasing enough that we might get a price run. Back here in 2011, this happened a few times. It happened in 2012 as it sent us into this double pump bull run. It stayed elevated for a long period of time after finding support here at 3% of realized cap. When it's below it, it tends to be heavy accumulation points of bear markets. And once it got back above it, it found support here. Transfer volume began increasing and we got this huge bull run. Look, it even found it as a resistance point here in March of 2018. But we spent multiple years with very low on-chain volume. And once it got back above 3% of realized cap, it found some support. This was our 2020 and 2021 bull run. And curiously enough, we have now found support above 3% of realized cap for our daily transfer volume here in late 2021 as we enter the fourth quarter. This has got me a little excited, friends, I won't lie, because transfer volume, high demand volume, is a necessary component of price discovery and of Bitcoin reaching multiple trillions in market cap. It simply has to happen. And so when we see transfer volume increasing, especially relative to the volume stored on the network, it gets me eager to find out if this is the beginnings, the whispers of our next rally. We're starting to see pieces being laid that the rally is happening soon. Demand volume is picking up. Transfer volume is picking up. Accumulation continues. And the derivatives market seems to be holding steady and not pulling price down with it. All of these factors are kind of mixing into this soup of anticipation. And in the next few days, it will be very important to watch the on-chain volume and the supply dynamics that we've been focusing on this channel to make sure that everything remains on track for future tests of the all-time high. This is also a Workbench chart. I'll be happy to leave a link to this one in the description as well if anyone would like to play around with this. All right, those are the charts I wanted to show you this morning. The biggest bear factors right now, in my opinion, are macro in nature. They have to do with inflation concerns, with supply chain constrictions, with COVID and lockdowns, with economic concerns about fiscal and monetary policies. Those kinds of issues are weighing against Bitcoin's rally more than any of the on-chain dynamics right now. We'll of course keep an eye on everything over the coming days, and we'll continue to assess our thesis that hodlers are restricting the supply for new buyers in anticipation of another rally. Make sure you follow me on Twitter at TXMCTrades. I post a ton of observations and comments all day long. You can interact with me there and ask questions about the video and charts that we look at. Make sure you leave feedback in the comments about things you'd like me to discuss in future videos. The start of Q4 looks pretty strong, but I'm not someone who likes to get overly bullish and overly excited, so I temper myself and try to remain level-headed. It's the best way for me to make good decisions about my investments, and Bitcoin is my primary investment. With all that said, I'm going to let you guys go. We'll make another video here in the middle of the week and check in on things. Until then, take care of yourselves, enjoy your Sunday. We will speak again soon. Thank you, friends. Cheers.